Over the last couple of weeks, markets, and especially the bond market, have been behaving in a way that's confused many market analysts and commentators. However, these markets have been telling us for over a year that they've been worried about something, but it's been impossible to know exactly what. Recently, banks like Silicon Valley, Signature, First Republic, and Credit Suisse all began failing. And while there's no question that these banks in particular were poorly managed and failed to manage their risk, so they couldn't handle a combination of higher interest rates and customer withdrawals, there's more to this story in what's happening in areas of the market that are unseen, beneath the surface, if you will. Businesses like grocery stores or Walmart, as you know, buy goods in a wholesale market of suppliers and then resell them to us in the retail market. Banks and other financial institutions also have a wholesale market, but for money. Money must be freely traded and available in that market to keep the wheels of our financial system greased. It needs to be able to flow from those banks with too much available cash, like the big banks today, to those without enough, like many smaller and regional banks today. When this important plumbing gets clogged, it wreaks havoc that can also make it appear in the real economy that you and I live in. Think of this as what's invisible and beneath the surface, but plays a major role in everything above. What's above, the economy we all interact with, has appeared solid by most measures. The Fed and policymakers have done nothing but point to low unemployment and high inflation over the last year as a way to say that the economy is strong. They say it's too strong, in fact, so the Fed needs to step in and slow things down by raising rates. All the while, the bond market and futures markets for money have been telling us for more than a year that they're worried about something in that unseen world beneath the surface that's not captured in unemployment or inflation numbers. When money's hard to get in this wholesale world, it's the most vulnerable who are most at risk. Warren Buffett famously quipped regarding the 2008 financial crisis, "It's only when the tide goes out that you see who's been swimming naked." And it's clear that a handful of poorly run banks were standing too close to the shore, making it hard to get the short-term funding that they needed to meet depositor demands. The question is, how far will the tide recede, and who else gets left exposed? We know that the Fed does have some concerns here, even if not stated publicly. They've created a brand new program, BTFP, that along with central banks of England, Canada, Japan, among others, they also made changes to swap line operations to give greater access to that short-term funding abroad. Now, without getting into the details of these systems and how they play a role, we can suffice to say that this means that the Fed, who's supposed to be a lender of last resort, sees these wholesale markets for money not functioning well right now and feels a need to step in and help out. Regardless of these actions, markets haven't appeared to be reassured. Short-term rates have fallen sharply in spite of the Fed continuing to hike rates. T-bills have been auctioned by the Treasury over the last few weeks, with some buyers accepting a 0% return, indicating a greater need to own those short-term treasuries as collateral to get the funding that we see is becoming harder to come by for certain institutions. And on Friday, insurance to protect against a Deutsche Bank default went through the roof, even though by all accounts, Deutsche Bank is a solid and very well-run bank. This is yet just another example of markets saying that there's something else here beneath the surface that they're worried about. Now, no one knows how these things will play out. If we've already seen the fallout or if there's more to come in the next few weeks, months, or years ahead. And that's why we need to take action today, to protect ourselves for whatever lies ahead. The fact is, when negative things happen in the financial system or economy, it's too late to protect ourselves from those events. This is why many people choose to protect themselves by adding gold to their portfolio. Gold's an asset that doesn't depend on the banking or financial system and has been a store of wealth even during the worst crises. If you don't have protection gold may offer as a part of your portfolio, U.S. Money Reserve can help. Give us a call and speak to one of our account executives about how easy it is to acquire gold, even inside of a retirement account, such as an IRA.